From 2006 to 2012, the United States faced a severe housing slump, causing a global recession. Little attention has been given to the pre-crash years, often called the bubble era, when U.S. home prices steadily increased, leading to a modern-day gold rush. The current housing market resembles this scenario, with prices gradually rising since the 2012 crash and surging after 2020. This situation is not ordinary and appears to be a new bubble in its final speculative and greedy stage. Surprisingly, prior to the last market crash, several individuals were sounding the alarm bells about the impending housing market crisis. Hollywood may make it seem like it was only one lone individual who foresaw the trouble, but in reality, many well-known investors and even regular folks understood that the market was inflating into a massive bubble ready to burst. Among these individuals was none other than the world's greatest investor, Warren Buffett. He voiced his concerns during the 2006 Berkshire annual meeting, which happened to be very close to the peak of the last bubble. Warren was posed with a question regarding the state of residential real estate, specifically whether it was experiencing a bubble. What you're about to witness and hear is remarkably reminiscent of the ongoing situation in the United States today. Warren not only highlights the risks involved, but also accurately points out that it's not everyday people at fault. It's the speculative real estate investors who are playing with extreme leverage and fueled by greed. This perilous combination, as he rightly anticipated, would eventually lead to a catastrophic collapse. Let's tune in to his words. From time to time, even in great locations. We've seen it happen in New York a couple of times in the last 30 years. The swinging properties' values have just soared, and what we're observing in our residential brokerage business, spanning across numerous states, is a noticeable slowdown. If you're finding this video informative and engaging, kindly consider hitting that like and subscribe button. Everything fuels the algorithm and greatly aids our channel, and your support is genuinely appreciated. Today, we observe this phenomenon most prominently in what used to be the hottest real estate markets. These markets, in my opinion, are likely to experience the most significant decline. They happen to be the ones that witnessed the biggest bubbles, primarily in the high-end segment. These are areas where individuals bought properties not for personal use, but for investment or speculative purposes. For instance, consider someone who invested $100,000 in a house and mortgaged it for $270,000. If the property's value drops to $250,000, they may not necessarily move out if they have a stable job and everything else is intact. In such cases, the financial loss isn't substantial, even if the market value momentarily falls below the loan value. But when you have investors or speculators in the picture, essentially engaging in what can be compared to day trading of condos, that's when things can take a sharp turn. The market may initially stall, but eventually it can undergo significant swings, with moments of stagnation followed by sudden reopening. In his response, Warren's primary focus is on investors who have transformed the real estate market into something akin to the penny stock market. These investors are excessively reliant on leverage and are fixated on quick flips, reminiscent of day trading conducted on a computer. He emphasizes that recent data shows a substantial increase in investor activity over the last 2 years, reaching unprecedented levels. Many of these investors are employing speculative funding methods that often go unreported, which includes risky and even fraudulent loans. Furthermore, Warren highlights that the real estate market is a striking example of the law of the vital few. Unlike stocks, which have continuous live trading from Monday to Friday, home prices are determined based on comparable sales, comps, often derived from a limited number of transactions. This method is inherently flawed as it can quickly swing in either direction, with just a few unfavorable sales, ultimately causing entire neighborhoods to reprice. This is why real estate crashes can seemingly appear out of nowhere, with drastic and sudden shifts in value. For instance, he illustrates how these investors only need one buyer to agree to their asking price. This kind of behavior was prominent in various markets, such as Phoenix. For example, in some months, house prices dropped by more than 5%, equating to a loss of over $15,000 in just 30 days for a $300,000 house. During the grim period of 2008 in Phoenix, the average home lost a staggering 37% of its value in 1 year, from March 2008 to March 2009, citywide. Real estate agents and investors active during that time will tell you that specific neighborhoods often fared even worse, with some homes losing over 60% of their value in a single year, resulting in significant losses for investors. Ultimately, this bubble-like behavior, where there's an enormous price surge, typically ends with some form of collapse. The underlying cause, time and again, is reckless lending to individuals driven by excessive greed. Today, we witness numerous instances of investors obtaining loans loans to buy Airbnb properties that are struggling, investments that are losing money, and rental properties with negative cash flow. It's a familiar narrative playing out once more. During the same Berkshire conference mentioned earlier, Warren and Munger were questioned about these precise lending conditions and how they consistently lead to the same outcome. Let's listen to their insights. Warren highlights the shift from reckless lending practices in manufactured housing finance to stick-built houses, emphasizing the imprudent extension of credit in the American housing sector. He warns of potential problems in the stick-built housing sector down the road, citing the adverse consequences experienced in the manufactured housing sector due to such lending practices. Warren underscores that irresponsible lending tends to have far-reaching consequences, often taking time to surface, akin to a hidden disease that spreads before becoming apparent. He points to historical patterns, including the 1980s commercial financing leading to events like the RTC and the savings and loan crisis, driven by a series of ill-conceived projects. Developers build what they can finance. The current real estate bubble reminds us of the early 2000s, even if the conditions aren't identical. History may not repeat, but it often rhymes. Today, bad loans fuel speculative investors in hotspots, causing substantial price spikes. However, as mentioned earlier, this peak will eventually see a sudden and turbulent decline. Housing crashes tend to be abrupt, which can be frustrating. During a prolonged descent, the steeper the gains, the more we tend to believe the decline will be equally steep. The key takeaway here is that while it may seem like an exhilarating climb, the other side of the peak can be treacherous. It's a valuable insight that prompts us to approach the housing market with a keen eye, a measured approach, and a watchful perspective. Thanks for watching. If you found this video valuable, please like, subscribe, and share your insights on the housing bubble crash in the comments below. Your input is appreciated.